PayPal stock is definitely not worth $70 today, and depending on your valuation, this could go drastically in either direction. That is why you have to stick to the end, where I go through 3 different scenarios of how PayPal could actually play out. Now, I know PayPal is a company that needs no introduction. It has absolutely fallen off the cliff in recent times, falling from a high of $310 all the way down to $50, and almost 84% drop. Now, despite recovering some of its losses in recent weeks, it is still down 78% from all-time high. Now, I have a January 2026 call option on this company. In this video, we're going to talk about the reasons behind this investment, the timeline of the January 2026 calls, and the potential returns depending on how the company performs. But as always, potential is a dangerous word, so let's dive in.
Did you just pay with PayPal?
Yeah. Now you can use it in stores, and the cashback's wild.
Whoa. Are you guys feeling this? I want to pay with you everywhere!
Now, in the past, right, I've never thought of investing in PayPal because I never actually felt like they were a really interesting business. Now, in all honesty, right, before I even opened my position in PayPal, I really struggled to think about the last time I actually used their branded products or services. You see, this is largely because most of the services they provide is actually also provided by my local banks in Singapore, and because my accounts are already within my local bank, it's much more easy for me to actually use the local services. At the start, they were, in my opinion, a little bit more clunky than what my local banks had to offer. So because of that, I hardly ever use my PayPal account, and if you actually take a look at this screenshot over here, I actually show that my PayPal transactions only occurred this year after, starting to invest in this company because I wanted to test out the product, and such is my relationship with the company. So why in the world did I actually start a position using a call option all the way in January 2026? Now let's talk about PayPal's problem. I think under previous management, PayPal's direction was very haphazard. There were a lot of acquisitions and then, chasing growth of revenue at all costs without any synergy, without any clear plan in mind. So this basically led to compressing margins, and yet at the same time, growth wasn't up to expect. So what changed? Well, Alex Chris came in as a CEO. That definitely changed. He had a good track record at Intuit, and their execution over the last couple of months has been very impressive. PayPal has become a much more focused company. You can actually see the direction that the company is going in, and they actually sold off a lot of previous acquisitions done by the previous management that did not bring value to existing customers. So basically, the expectations is that PayPal will have a slow and steady rise like Intuit had in the past, and 2024 is a transitional year for them as mentioned by the company. So very simply, right, PayPal's business basically has 2 components, the merchant side and the consumer side, as you can see in this diagram over here. So what they hope to do for the merchants basically is that on their website, they will have this button that says PayPal, right? And then consumers can actually tap on the button and make payments. So sometimes when you have a few ways to pay like Apple Pay and Google Pay and things like that, basically what all these companies are actually vying for is basically your click as the consumer. So PayPal's aim is to make their service the most frictionless for the merchant and the consumer so that they can actually drive more customer purchases. So what exactly is the value propositions for merchants over here? Like, why would they actually choose to use PayPal over other companies and putting the PayPal button on their buying page? You see, what PayPal wants to do is actually help the merchants increase their amount of conversions, because apparently, a fairly large number of sales are actually lost on the checkout page, which means people are already at the payments page, but because of some inefficiencies in the payments process, they basically reconsider their purchase and actually maybe not make the purchase at all. So apart from that, right, PayPal actually helps the merchants by detecting fraud. They help to analyze consumer data. They give this data to the merchant so that the merchant has all this consumer data to decide how they want to do marketing in future. And of course, they also help with various credit solutions like buy now, pay later and alternative payment methods. So all of these help to drive an increase in conversion for the merchants, which ultimately generates a greater total payment volume. And this is how PayPal actually earns their money, right? They take a cut from all these transactions that happen. So if you can see over here, what it says is that, when merchants actually use PayPal, there's a 88.7% conversion, which is 60% more than other payment providers, 33% less cut abandonment. And this is speaking to all the people who actually cut out their whole Shopee page but never ever make payments, right? This is talking about you. And of course, people tend to go with brands that they trust when it comes to payments. So, PayPal is a world-renowned brand. And because of that, I think customers tend to trust the website even more and feel more comfortable making payments on their website. So another aspect of their merchant business is this product called Braintree. Now, Braintree, on the other hand, is basically the unbranded product. This means that the backend is still run by PayPal, but merchants can slap their own branding on the front of the payment processor. So as you can see, a breakdown of Braintree's customer base is quite diverse. It involves, many different industries in many different countries all around the world. world. And just to name a few, very famous or popular companies that people tend to know that actually uses PayPal on the back end, basically things like Ticketmaster, all the Swifties out there when you go for Taylor Swift concerts, TikTok, Airbnb, all make use of them, right? So thank you, Swifties. Big companies like Estee Lauder, MAC Cosmetics, both make use of Braintree as well. So guys, whenever next time your girlfriend actually asks you to go and buy makeup, don't stop her. Okay, PayPal earns more money, and just make sure you invest in PayPal. So, it's like money in, money out like that lah. The more she spends, the more PayPal earns, and the more your stock price actually goes up. And so now let's talk about the customer's value proposition. Why would consumers actually choose to use PayPal, right? So basically, the first thing they do is they facilitate money transfer between people using Venmo. From what I understand, this is very similar to Zelle. Now, the main difference between Zelle and Venmo, correct me if I'm wrong, from what I understand is that Zelle is basically, for Singaporeans watching this, Zelle is a bit like PayNow, right? You basically transfer money from you to your friends. And the main difference between Zelle and Venmo is that Venmo also acts as a digital wallet, whereas Zelle basically only facilitates the transfer of money. And I think the convenience here, the added convenience, is that they also allow consumers to perform international transactions and crypto transactions, which banks don't allow at the moment lah. So additionally, with all this data on the consumer spending habits, what they're able to do is that they're able to personalize shopping experiences and recommendations. And so they will link up consumers with, the appropriate merchants and things like that. So this increases the chances of buying stuff. And on top of all of this, they also have their buy now, pay later, which ties in nicely during the checkout. So you can see what PayPal hopes to do is to make it easy for the consumer to buy and to make it easy for the merchant to sell. And, as long as they increase the transactional volume, they actually make more money. Now, for some of you who might be watching my previous videos, you actually notice I place a rather big significance on management. So let's take a look at PayPal's management, right? So Alex Chriss was appointed PayPal CEO back in September of last year, 2023. He came in with a pretty impressive CV. He was at Intuit for a total of 19 years, most recently serving as their vice president, right, where he focused on small and medium businesses, which ties in perfectly in his role as PayPal CEO. So he was responsible for integrating, the companies that we know, MailChimp and QuickBooks, to the Intuit platform. And basically what this did, right, was to actually help Intuit reach out to a new customer demographic. So it's not just Alex Chriss, right? They basically swapped out the whole management team. I'm a sucker for good management, as you already know by now. And my problem with the previous management team, right, is that they were always trying to find something new for PayPal, or trying to reinvent how PayPal does payments. But I think payments, you don't really need a new payment solution. What you actually need is better payment solution. And I believe this is where Alex Chriss and his team can really come in and help them with the expertise that they currently have lah. So now I have to say that you can't really talk about, Alex Chriss and his start to his role as CEO as PayPal without talking about his whole shock the world moment. Now, if you don't know what I'm talking about, not long after Alex Chriss came in as CEO, he actually told people that PayPal is going to have some announcements that are going to shock the world. And because of that, the stock price actually go up. But however, after he made some of these announcements, people actually realized that, some of these announcements were not that shocking. And because of that, the stock price actually came all the way down. So that is, in a sense, a slight blip in his CEO career. But I think we can cut him some slack, because I believe, right, a lot of people were focusing on this whole shock the world situation. They actually missed out on some of the key things that Alex Chriss talked about during his announcement. Some of these things are already being implemented, and we can see it play out in the financials, as I'm going to talk about them later on. Because we have to accept, Alex Chriss is not like Elon Musk and Alex Cup, that kind of charismatic CEO, but what he is an operator, and a very good one. And that really, really shows when we look at the financials of the company. Like I said, right, these are not new things. These are things that actually I felt like PayPal should have been doing long time ago. So I'm not going to touch on all 6 of the innovations, but just the ones that excite me the most and form a core part of my thesis lah. So the first thing is actually payments using fingerprint and face IDs. Now, when I hear this, I was actually quite shocked. It's actually quite brainless to think that, if you are a payments company, you need to already have this. And I think this is more of a reflection on, the misstep of previous management, where they kind of lost their direction along the way. So this is definitely long overdue. It definitely reduces the friction for sure. And like I said, this is not shocking, but definitely makes the payment process a lot more smooth lah. Now, what actually excites me, the second thing, is basically the smart receipts. I think this is an interesting concept because, PayPal have said that 45% of their consumers open their email receipts, which is quite surprising because I possibly belong to the 55% that don't open email receipts. So what they do is that they actually allow merchants to advertise on all these receipts by having all these buying habits of the consumers and things like that, right? The merchants are able to offer deals, able to offer cashback inside of these receipts that drives the second and third purchase.
You get 5% cash back on any category you choose.
Really?
Every single month.
And even more when I shop online? Jasper, that's unbelievable! Is it too sexy? take it.
So from the way I see it, this is basically like those restaurants and things like that. They keep giving you a $10, $20 voucher so that you can have to come back again to spend, right? So this basically drives the second and third purchase lah. Now, if you go back to the fundamentals of the business, how PayPal actually generates most of their money is actually through all these transactions between merchants and consumers. So what they're trying to do is to pair up the consumer with the most suitable merchants so that they will make a purchase, and through all these transactions, PayPal will actually increase their revenue lah. So the more they can encourage these transactions, definitely the more that they earn. So which brings me to the third innovation, fast lane. Now this is PayPal's way of targeting the guest checkout market. You see, this makes it easier for consumers to check out without disclosing too much of their information.
And it keeps my info safe, even at this shady lemonade stand.
Who you calling shady?
Oh, like this is fresh squeeze. Give me a break, Logan.
And so what PayPal actually found out, right, is that 25% of all sales actually stop at the checkout process because people don't want to provide all these personal details to certain companies that they are not very comfortable with. And so what PayPal does is basically allow safe transactions without revealing all of these details, which is extra revenue for PayPal. So, like I said, this is not revolutionary, but this helps to protect their market share. And honestly, I'm most excited about this. It fits into Chris' expertise working with small and medium businesses, and I'm quite excited to see how this scales for them. Now, of course, apart from this, they talk about improving their app, onboarding more partners, and improving Venmo for businesses. But of course, these are the three things that excite me the most because it can be implemented quickly, and which means that this can drive the most immediate impact to their top and bottom line in terms of revenue and profitability for the company lah. So if we take a look at the total addressable market that PayPal is going after, digital wallets and payments, right, it's a space that is poised to grow at about 22% CAGR from now to 2032, growing from a total of $124 billion to $590 billion in 2032 lah. Now, the global e-commerce market, this is where actually PayPal sees a lot of its revenue. We are talking about a $6 trillion industry today that will only keep growing. They're going to penetrate into things like grocery lines and things like that, right? So a lot of grocery stores are moving online as well. So this will drive a CAGR of about 8%, becoming an $8 trillion market just by 2027, right? This is according to research done by WeThrift and JP Morgan, as you can see over here. Now, despite what I initially thought about the company being a little bit slow and sluggish and things like that, which honestly they really were, they still have a relatively healthy market standing. If you take a look at the payments platform used in each continent, in Africa, Asia, Europe, and in Oceania, PayPal is still the top payments processor. However, in North America, they are third behind Visa, MasterCard, and in South America, fourth behind Visa, Amex, and MasterCard. Now, if you aggregate all these data together, you can actually see that PayPal's market share still stands at about 20%. I think people are generally worried about them losing their market share to companies like Apple and Google Pay and things like that. And I think to a certain extent, yes, I can see where these people are actually coming from, but I guess it's the same concept as, Apple and Spotify. When Apple Music came out, a lot of people thought that, Spotify is not going to be able to compete with them. But because Spotify is so niche into the music industry compared to Apple, whereas Apple Music is just one of their many businesses, Spotify is able to innovate a lot more. So I think in the same way, because PayPal is, niche into the payment space, they're able to offer better value to their consumers at a faster pace than Apple and Google. So Apple and Google, to them, this is only one of their business, one of their revenue arms. But because PayPal is focused in this industry, I do think that is a moat for them as well. However, that is not to say that the competition is not real or insignificant. The competition is real and the competition is significant. But I believe that, when you go after a big total addressable market, it's not just winner takes all. As you can see over here, there can be many winners at the same time. Now, I just want to say this is exactly why I have an almost unhealthy obsession when it comes to TAM and good management when I choose my investments. You see, if you take a look at what PayPal told us in their Q2 2024 earnings, in the second line, they actually say branded checkout, Braintree, and Venmo has been contributing to the highest transactional margin growth since 2021. Right? On top of that, they actually tell us that monthly active user accounts are growing and they're refocusing profits on existing business to drive efficiency rather than, what previous management was doing, haphazardly buying up smaller businesses and things like that. So if you see over here, they say that we're reinvesting cost savings into growth initiatives such as checkout, omni-channels, and ads platforms. So as you can see, PayPal themselves actually has told us that they are slowly transitioning their business into involving advertisements as well, which is basically what we have been talking about throughout the whole video, using things like smart receipts to drive second and third purchases by linking up consumers with suitable merchants. So on top of that, as a cherry on top, basically they raised their full year 2024 guidance for the transactional margin dollar, for earnings per share, for free cash flow, and for share buyback. So definitely these are all things that we want to hear as an investor. Now, usually at this point, what I'll do is I'll dive into, the the financials of the company, compare the last couple of quarters and look for certain trends. However, in PayPal's case, right, there's some slight differences over here. There's a fundamental shift in the business. There's new management. So what we're looking for is not so much trends, because a lot of these trends belong to how the old management performs, right? What we're actually looking for are inflection points, points where the new management have come in and improved the business. So let's start with the most basic concept, right? Monthly active users. Now, if you understand PayPal's fundamental business, like I was mentioning earlier, the more people on their platform, the more people using their platform, they actually make more money because they actually take a small fee from all these transactions. So basically, the monthly active accounts declined from a high of about 435 million back in the fourth quarter of 2022 all the way down to 426 million in Q4 2023. And since then, that has inflected up. In the first quarter of 2024, we saw that it ticked up to 427 million. And in the latest quarter, it continued the uptrend to 429 million. Now, another way that PayPal actually makes money is not just by increasing the number of users, but by increasing the number of times each user uses their platform. So the total number of payment transactions were up 8%, and the transactions per active account was up 11% year over year. So people are slowly using more and more of their products, and I think this is testament to what the new management has done to make their product easier for people to use. So this is fantastic, and I believe this will continue to grow as they continue to revamp their app and add more partners in and things like that. So if you follow PayPal over the years, you actually realize that they in the past ran a lot of very unprofitable campaigns which new management has stopped already, and all these unprofitable campaigns basically got people on board onto the platform, signing up for all these promotions and things like that, and then after that never really using the accounts. So when we actually saw the decline in members is basically the churn lah, and it's good to see that the account numbers are back in the uptrend along with transactions. And so you see, to me, investing can be quite easy because all we actually need to do is to understand the company and drill down to the key growth drivers of the company, track its growth using tangible metrics, and naturally, as all these key growth drivers continue to work for the company, revenue will start to grow. So let's take a look at PayPal's revenue, right, and how all this increase in monthly active users translates to revenue. Now, I love this particular disclosure because you can actually see the revenues are not just growing when you compare year over year, but it's also growing when you compare it to the previous quarter. So if you can see over here, right, the total net revenues in the most recent quarter is up 2% quarter over quarter and 8% year over year. So in Q2 of 2024, they actually brought in $7.8 billion in terms of revenue. Their operating income came in at $1.46 billion, which is up 24% year over year with an 18.5% margin. So this is continuing its uptrend after bottoming at around 15% last year, I believe, their operating margin under previous management. And their EPS came in at $1.19, which is a 36% year over year growth. And on top of all of that, they also had about $1.5 billion in share buyback. So overall, this is a very solid, a very good quarter. And we can see the inflections in their business, and now it's on the management to keep up this performance going forward. Now, before we look at other parts of the financials, right, I want to point out that their unbranded platform, Braintree, is found under this segment called PSP, right, unbranded card processing. And under old management, this was a segment that caused a lot of concerns because this segment or this particular service was actually priced very, very low so that they can gain a lot of customers. However, the downside is that because of that, this segment was actually super unprofitable, which caused their margins to contract. So Alex Chris, when he took over, he actually said that, hey, this is actually a very good product. We don't have to brand so low. We can actually price according to the value that we offer to the customers lah. So hence you can see over here, as they start to price to value, they increase their prices and things like that. You can actually see a slowdown in adoption. But for the first time, this segment is actually profitable already. So you can really see the difference good management has on the company. And so with that, let's take a look at their free cash flow and their balance sheet. Now, in terms of cash flow from operations came in at about 1.5 billion and a free cash flow of 1.4 billion. And if you look at their balance sheet, cash and equivalents total 18.3 billion. That is 12.2 billion. So they are quite healthy over here. And you can see over here, they basically returned 1.5 billion to shareholders by repurchasing 24 million shares of their stock. So moving forward, we want to look at their guidance. Revenue growth should continue around where they are today, which is what they have been telling us, mid-single digits. EPS, they say high single digit, but if you just look at this quarter, I think we can expect them to actually beat their EPS projections lah. So I have a feeling that they will beat, but we'll really take a look in October. Now, they have also increased their share buyback to $6 billion because their free cash flow is also projected to increase to $6 billion, which means that, all of their free cash flow this year is going back to buying shares and reducing the float. For those that don't understand why this is significant, right, right? Basically, when you reduce the amount of shares, it will help to boost the earnings per share, right? Because total earnings is basically your net income and you divide it by your total number of shares. So if you decrease the total number of shares, your denominator, the number at the bottom, becomes smaller. So your EPS actually starts to grow faster. Now, right now, right, I actually want to focus on this one particular aspect of PayPal's business before we go into valuation. And you can keep this in mind when I talk about some assumptions later on and decide for yourself whether or not the valuation makes sense for you. Now, I know I've been talking about Fastlane earlier on and how this is their way of, targeting unbranded checkout. So in the most recent earnings, management actually said that with Fastlane, they're able to capture about 60% market share of all unbranded checkout, which is huge, right? And this JP Morgan analyst, I want to just take a screenshot of this report to show you, actually tells us that they're raising the conversion rates, right, at the unbranded checkout from 45 to 50% all the way up to 80%. So this is basically extra revenue generated for PayPal. And you can see at the end of this report, he actually calls it a significant growth opportunity. And so with that, let's take a look at PayPal's valuation when we want to compare it with some other companies in the same sector. When it comes to P ratio, right, you can take a look at this graph over here. PayPal actually ranks the lowest among all the companies that we're comparing with today. So with things like Adyen, Fiserv, Global Payments and things like that, PayPal's P ratio is the lowest at about 16 to 17. However, you take a look at this second slide, right, their net income of 4.4 billion in the trailing 12 months is the highest among all these same companies, despite supposedly being a struggling company. So why is the PE ratio so low for PayPal? Well, because other companies can command this higher PE because of their growth potential. However, under previous management, PayPal, like I said, has been quite haphazard, which is why they do deserve their low PE ratio. And so the question is, with everything we have covered so far, with the new management coming in, with all these inflection points that we have talked about, is PayPal a dying company, or is PayPal a company so beaten down, so kicked to the side that perhaps the turnaround has kind of been ignored? And that is really the question that is facing investors today. Alright, so right now, as I take you through this simplified DCF, I just want to go through some of the assumptions that were made along the way. And the first one is regarding the WACC of the company. So the WACC is slightly different from what I did previously with Google. I did not calculate this manually. I actually used the figures in this report and adjusted it upwards so that I'm a little bit more conservative with my assumptions. So for those of you that are new to this, basically the WACC tells you the expected rate of return when you invest in a company. The higher this number is, the lower the fair value of the company will be. So I just want to spend a couple of seconds just to talk everybody through this so that we're all on the same page. Now, for instance, I invest in a company and I believe this company will reach $100 eventually. Now, if I expect to get a rate of return of 10%, then I'll feel comfortable buying the company at $91 because $91 plus a 10% growth, that is $9.10, will eventually take me to my target price of $100. So similarly, if I expect to get a 20% return from this investment, then I won't buy the company at $91. Instead, I will want to buy the company at $84 because a 20% growth from $84, which is $16.80, will then get me to my target price of $100. And so that is why with a higher WACC, right, generally what happens is that there's a lower fair value of the company. And so in my DCF, basically the WACC, the assumptions here to be a little bit more conservative will be at 8.5%. Where do we get all the numbers for the DCF? Basically, I've taken the historical performance of PayPal. As you can see over here, the revenue growth has slowed down from the mid-teens to around 8% range. So that is what we are going to use going forward. And if you take a look at this cash flow from operations, right, the cash flow margins basically drop down from 35% all the way to the lows of 16%. So generally, if you take a look at the numbers, it hovers around the low 20% range. But in 2023, they actually fell all the way down to 16%. Now, this year, definitely under new management, things have been a little bit better. It has inflected up a bit to 18.7%. So let's see where all these numbers actually take us when we put all these numbers into our cash flow. Now, I want to bring your attention to these two yellow boxes over here. You can actually see the words implied price and current price. Now, current price, very straightforward. This is the last closing price for PayPal, which was Friday, 13th of September, 2024 at $70.10. So the implied price basically is calculated from, all the different assumptions in terms of revenue growth and your cash flow margins. And so basically, in English, what this means is that if I buy PayPal at the implied price, I'm expecting X revenue growth and X percentage of cash flow margins. So in this first scenario that we actually see over here, if somebody buy PayPal at $67, what you're assuming is there is 0% revenue growth from now till the end of the decade and a cash flow margin to stay at historical lows from now until the end of the decade at 16.5%. And if those are your assumptions, then, PayPal currently is slightly overvalued. In this second scenario, you can actually see that the implied price equals to the current price. That is because I make a big change in the numbers. Can you spot the big change? Let me give you a hint. Now, you can actually find it near the like and subscribe button. And once you hit the like and subscribe on this video, the change will appear. You see, I told you, once you hit it, the change will appear. Thanks for your support, and back to the video. Now, so what this means, right, is that if you buy PayPal today at $70.10, you're expecting revenue growth to increase from 0% to a whopping 1.2%. Okay, from now until the end of the decade, with cash flows again being at historical lows till the end of the decade. And if this is your assumption for PayPal, then $70 per share is a fair price. However, there is a third scenario. Okay, this third scenario is my own assumption. It could be too bullish, it could be too optimistic, so I could very possibly be wrong. Please don't take this too seriously. I'm just telling you what I think. Now, in my third scenario, Alex Chriss waves his magic wand and manages to maintain revenue growth at about 8% this year and falling 1% every year thereafter, which means if you take a look at the revenue growth, 8% in 2024, 7% in 2025, 6% in 2026, so on and so forth, all the way until 4%, and then eventually trailing off. And if we take a look at the cash flow margins, what we are assuming is that cash flows never ever go back to the 20% range and stay, roughly where they are today at the 18.5% range from today to the end of the decade. And if that happens, PayPal should be trading at $96 today, and that is why I initiated a position with a $95 January 2026 call. Why did I position my investment this way with a January 2026 call? You see, I believe that PayPal's rise will be a slow and steady one. This is not going to be like Facebook spiking all the way back up to all-time highs from $88 to over $500, right? I don't expect PayPal to actually go back to all-time highs anytime soon. Hence, I want to introduce a little bit of volatility to the position so that I can benefit more during the recovery. But bear in mind, I think when we deal with options, right, I think the danger with options is that you can be right in terms of the price direction and wrong on timing and still lose money. So basically, I actually also had PayPal 2025 January calls, and the moment I heard Alex Chriss say that 2024 is going to be a transitional year, I knew those call options were dead in the water lah. And the second reason why I chose to use options instead of buying the shares outright is that because the expectation going into this trade in the first place was that this was going to be a kind of swing trade, a more long-term swing trade spanning a couple of months. And so because of that, I would rather allocate my capital into higher conviction names, and I did not want to spend so much capital into this position lah. However, after saying all that, I have to say that the way that Alex Chriss has managed PayPal, looking at how he has executed the things that he and his management team are doing, has got me to reconsider that position, and I might want to consider eventually turning some of these profits from the call option into shares. However, the one thing I can't fully wrap my head around is that if I actually want to invest in a large mature company, then why should I invest in PayPal? I would much rather invest in companies like Google and Amazon. But saying all of that, I think the perspective that I have right now is that I really like PayPal from a valuation perspective as a turnaround play. But as a longer term hold, I think I need to see more to be more convinced lah, because at the moment, I think Google and Amazon are better businesses. So I'm really quite on the fence on this. But if you're interested in another name in the fintech industry, which I have higher conviction on, I talk more about it in this video over here, and I'll see you in the next one.
I wanna pay with you everywhere.
I'd really like to pay with this.
I know, right?
No, I mean like move.
Oh, okay, yeah.
Every payment, everywhere, every time. Don't just pay, PayPal.